Hello guys, now we're going to do May June 2018 question number 3, and question number 3 is about statement. It says prepare the statement of profit or a loss and other comprehensive income for Slovakia traders for the year ended 28 February 2017. And we also have question B, which says prepare the statement in the change in equity for the year ended 28 February 2017. Okay, so let's get started. So now this is what you do whenever you're preparing for the statement of profit and loss. Okay, question number 3. A, please write the heading, or we call it the title, statement of profit or loss and other comprehensive income of Slovakia traders at 28 February 2017. Okay, now when you do the statement of profit and loss, you have the first thing first to do. So you are given two columns. So the first column is for the transaction and the second column is for the total amount. Okay, so you need to calculate what we call gross profit. Okay, now in your mind, how do you calculate gross profit? So here is the formula. Gross profit is sales or revenue less cost of sales. Okay, as simple as that. So the answer you're gonna get is your gross profit. So let's see what we have on the transaction. We've been given that our sales was 2,800,896 and our sales returns was 20,712, and the discount which was granted for those sales was 7,284. So now you'll come here and say, how do you calculate your sales? Sales or revenue is sales minus sales returns minus discount granted, which is what I did here. I took the values. I said sales minus the value of sales returns minus the value of discount granted. And how much did I get? I get 2,772,900. So remember, here is for the transaction, here is for the totals. So my sales, let me put it well here. My sales will amount to 2,772,900. So this is the amount of my sales. So this is what you do when you calculate gross profit. It's sales or revenue minus or less cost of sales. So how do you calculate cost of sales? The cost of sales, fortunately, it was given, so you don't have to calculate a lot of things. So what does it mean? Remember, cost of sales is like the cost you incurred initially when you purchased those goods you sold. Okay, it's like those goods you sold at 2,800,896. Initially, how much did those goods cost you? So they costed you 1,800,000 and blah 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 blah. Okay, so this is your cost of sales. So we need to subtract the discount you received when you purchased these goods. So I came here and took this discount received and I subtracted from the value of the cost of sales, and then here I subtracted. Why? Because if they give you a discount, it means the cost of your sales will be less. Imagine if you're buying something of 10,000 and they give you a 1,000 discount, so it means the cost of buying that thing is now 9,000. It's no longer 10,000. That is why we have to subtract the discount received. Okay, now if we subtract the discount received, we're gonna get 1,838,000. So So remember, in accounting, when you subtract something, put it in brackets. It's 1,838,956 close the bracket and put a line beneath here. So the difference between the sales and the cost of sales is what? It's what we call gross profit. So what is the difference between the two? And then I'll take my calculator here. I'll say 2,772,900 minus 1,838,956. Okay, so my gross profit will be 933,944. So what is a gross profit? A gross profit is the profit that you incur before subtracting the overheads or other expenses. Okay, for instance, you buy something at 10,000 and you sell that thing at 15,000. So we cannot say your profit is 5,000. You know why? It is because we don't know about what other cost did you incur to sell that thing at 15,000. So it means you need to subtract. So if you had someone to sell it for you, you paid that person 1,000. So it means your profit is now 4,000. Okay, if you had to pay maybe a rent, it means your profit will be less. So that's why we say this is a gross profit. It means it's not the actual profit. So we still have to subtract some overheads, some expenses to get the actual profit of the year. So let's proceed. Now this gross profit should be added with incomes plus incomes. Okay, so from my information, May June 2018 question number 3, I've only seen rental income on the incomes, so we don't have other incomes. So basically it's rental income plus we also have the credit loss recovered. Okay, so we have two types of income. So now the rental income, they came here on the additional information number 5. A tenant, Mr. Matsatsela, already paid the rent for March 2017. Okay, so if Mr. Matsatsela has already paid rent for March 2017, look, our financial year ends at the 28th of February 2017. So it means whatever amount of rent Mr. Matsatsela has paid was extra by 1 month. So if we look at rental income, the rental income was 39,988. So this 39,988, it wasn't for the entire year. It was for 13 months because it covered the whole year plus March, which was the month after the financial year. So what are we going to do? We must divide this rental income by 13 so that we can find out how much Mr. Matsatsela was paying per month, and then we multiply by 12. That is why I came here and say rental income is 39,988 divided by 13 months, and I will see how much was he paying per month, and then you multiply by 12, and then I'll take the calculator and say 39,988, okay, divided by 13. So it means per month Mr. Matsatsela was paying 3,076. So if he was paying 3,076 for the whole year, because the statement of profit and loss, remember we do it once in a year. So for the whole year, how much did he pay? So you need to multiply by 12 because in a year we have 12 months. So say multiply by 12. So for the whole year, it means his rent is 36,912 instead of 39,988. So we need to eliminate the rent for March, because March is for the other financial year, not for our financial year. Remember, we close at the 28th of February 2017. So March 2017 is another financial year. So now we'll come and say our rental income is 36,912. Okay, what other incomes do we have? We have a credit loss recovered, credit losses recovered. So to get more examples of incomes, please visit page 52 on the start guide of FAC 1501. Visit page 52 start guide of FAC 1501 and go to equity on incomes. You will see the examples. We have a lot of them. We have interest on fixed deposit, commission income, profit for the sale of non-current assets, and so forth. Okay, so the credit loss recovered, how much did they recover here? It seems like they recovered 320. Let me use my ruler, sorry. Oh, come on. Yes, it's 320. So we recovered 320. So now, how much is our income? So you add these two to get the balance for the incomes. So I'm gonna come here and say 36,912 plus 320 is equals to, so it means our other incomes we have 37,232. So now we add gross profit plus other incomes. How much will we get? We add with the gross profit plus gross profit of 983,944. So we'll get the income of 971,176. Okay, so we're not done here. We just calculated the revenue of the business, and this revenue is not the actual revenue of the business because we haven't subtracted the other costs. Now let's go to expenses so that we can subtract the costs. So we have expenses. Okay, expenses, they can be admin expense, distributive, and so on. Okay, now on expenses we have what you call depreciation. Okay, we have what you call depreciation. I want to start with depreciation because it's sort of long, depreciation. Okay, so we only depreciate non-current assets like land and building, vehicles, and equipments. This is what we depreciate. So let's see what we have here. I'll take my book and then I'll look at depreciation. Number 6. Okay, provide for depreciation as follows: vehicle 10% using straight line, equipment 20% using diminishing balance method. So I'm not gonna explain depreciation, okay, but you need to follow my steps for the sake of time. I don't want this video to take a lot of time here. Okay, so we have a straight line, straight line method, and the other method, they said it's a diminishing method. Diminishing, sometimes they call it reducing. Thank you. So now the straight line is for the vehicles, and the diminishing is for the equipment. So diminishing is for the equipment. And then at what percentage? Straight line, they said is 10%, and then for reducing, they said is 20%. So now here's the formula. If you calculate straight line, you must say cost price of that vehicle times the percentage depreciation. Okay, so this is how we do it. So this vehicle, how much did it cost initially? So you go back to your table, vehicle, and then here's the amount of vehicle here. Do you see the amount of vehicle? Let's move vehicle 85,200. So the cost price is 85,200 times the percentage, which is 10%. 10 divided by 100. So how much are we gonna get? And let's say 85,200 times 10%, which is 10 divided by 100. I'm gonna get 8,520. So the depreciation here will be 8,520 for the vehicles. Now let's calculate the depreciation for the equipment. So here is the formula for diminishing method. It's cost price minus accumulated depreciation, close bracket, times percentage depreciation. Okay, now if you go to equipment, they say the cost price for equipment here is equipment here. It's 50,760. So the cost price is 50,760 minus accumulated depreciation. So the accumulated depreciation for equipment is here 30,004. So it's minus 30,004. Okay. 38,004, sorry, 38,004, close bracket, times the percentage. They said is 20% using, so it's gonna be 20 over 100. So I'm gonna do it that way. Open bracket, 50,760 minus 38,004, close my bracket, times 20 divided by 100, and then it seems like I got 25,000. No, it's not 25,000, it's 2,551 because there is a comma there. So it's 2,551. Now you add this depreciation. Let's add them. So if you add this depreciation, you're going to write that amount on the depreciation. So I will add this amount plus this one. So I'll say plus 8,520. And I'll get a depreciation of 11,071. So the depreciation now, depreciation is 11,071. Okay, we also have to calculate the deficit of let's see what we have here. We have the consumables, so we need to calculate the deficit for consumables. So how do you calculate the deficit for consumables? Okay, the deficit for consumables, what you're gonna say, you'll say this is the consumables which was remaining at the end of the financial year, and here we must have the consumables which was there during the year of 10,092. So now you must say the consumables that was there during the year minus the remaining consumables at the end of the financial year. So that's how you get the deficit. So you must say 10,000, is 10,092, which is the consumables that was there during the year. So it's gonna be 10,092 minus the consumables that is remaining at the end of the financial year, which is 9,300. So 9,300. So remember the consumables actually are the expenses. If you go to the expenses on page 52, you will see them. Consumables, you calculate them like this. Packing material, you calculate them like this. Stationery, you do the same, okay, depending on what you have been given. So here is for consumables. So if we subtract these two, what is the amount of the deficit? So it's 10,092 minus 9,300. So I got deficit of 792. So it's 792. Okay, let's proceed. The other calculations which I want to start with again is for credit losses. Okay, you need to know how to calculate credit losses. So remember, credit losses occurs when someone in a business is selling on credit. So some of the customers, how are they don't pay, and some might not pay because maybe they are dead. Some they are no longer working for various reasons actually. So now, if the customers who have been owing you, they fail to pay, it means it's a credit loss. So credit loss, what does it include? It includes credit losses plus return of as irrecoverable. So if a credit loss is written off as irrecoverable, in this case it means that person has disappeared actually. Maybe that person is dead. It means you have lost. Don't expect anything. So written off irrecoverable, it's a actual credit loss. It means you can't recover that money. Plus what again? Plus allowance of credit losses. Okay, let's see. Do you have allowance for credit losses? Yes, we do have. So if we have this allowance which is there during the year, we must actually have another allowance which is the allowance at the end of the financial year. Come on, where are you? Here we have the allowance. So we need to calculate allowance. How do you calculate allowance? We calculate it like this. Allowance is equals to, so what you're going to say, if you sell on credit and then initially you give yourself an allowance of 3,750, and then your initial allowance was exceeded, and now it requires you to increase your allowance to 6,529. So what does it mean? It means the difference between the initial allowance you made and this one, it's your credit loss. So we're gonna say our allowance should amount to 6,529. It's gonna be 6,529 minus the initial allowance of the initial allowance was how much? Was 1,000. Oh, come on, wait. Was 3,750. 3,750. Okay, now how much can you get only for allowance here? I'm gonna say 6,529 minus 3,750, and then I got the difference of 2,779. It's 2,779. So let's get started now. How much is our credit losses here? Our credit losses is it's 1,320. So credit losses is 1,320 plus the written off as irrecoverable. So the written off as irrecoverable, basically it's here on the additional information. Do you see on number 2, they say the account of Mr. K. Kryle for 750 should be written off as irrecoverable. So you add that 750 plus 750 plus allowance. And allowance, how much did you get? 2779. And then in total, how much will you get? Okay, so let's add here. Plus 750 plus 1320. So we're gonna get 4,849. This is what we're going to get for our credit losses. So now you'll come here and say credit losses, losses. Okay, you can show your transaction here. It's 1320 plus 750 plus 2779. Okay, and how much did you get? You got 4,849. Okay, so if you know how to calculate all of these are the very difficult part of the expenses. The other expenses you will just have to adjust. They are not difficult. Okay, let's proceed with our expenses. Let's come here. We have salaries and wages. So our salaries and wages is it's 699,030. So we move to additional information. Do you have salaries and wages? Okay. Salaries and wages. I only see insurance. So we don't have anything on salaries and wages. So it means the salary and wages will remain the same at what? At 699,030. So salary as an expense, it's 699 and 30. 699,030. We move forward. We skip salaries here. Let's skip the salary. We're done with salary. Let's move to rental income. We're done. Discount, we're done. Credit loss, we're done. Recovered, we're done. Interest on mortgage, we'll talk about it. Consumables, we're done. Telephone expense. Let's write down telephone expenses. You write them down. Okay, yeah, this question is very long, guys. So telephone expense is how much? It's 5,040. Do you have any telephone expense here? We have insurance. Okay. We don't, yeah, we do have telephone expense. Let's read on number 7. The telephone account for February was paid in March, 2,300. So okay, let's see what they want here. You are closing your financial year at February, and then you didn't pay for February 2017, but you paid on another financial year which started on March 2017, because remember your financial year ends at the 28th of February. So now it means you went to another financial year while you were owing the telephone expense of February 2017 of 2,300. So it means this 2,300 belongs to the February 2017 financial year. It doesn't belong to March. Okay, so we need to add 2,300 with the other telephone expenses. So telephone expense which was paid during the year is 5,040. So it's gonna be 5,040 plus 2,300 that was outstanding. So the outstanding should be added, okay, because it doesn't belong to the other financial year, it belongs to this year, so it must be added. So let's add 5,040 plus 2300. How much are we gonna get? We're gonna get 7,340. So it's 7,340. Okay, let's proceed. We move to insurance. Insurance is an example of expense, which is 5,490. So on additional information number 4, insurance includes amount of 3,000 which was paid for the period of December 2016 to 31st of May 2017. Okay, so 3,000 was paid for how long? So I need to take a rough book here and show you how we calculate here. Okay, insurance include 3,000 which was paid for a period of the 1st of December 2016 till the 31st of May. So we'll count from December to May. So it's December, January, February, March, April, May. So it's 6 months. So 3,000 was paid for 6 months. And then our financial year was ending on the 28th of February. Okay, so now we want to see the actual amount here because if they paid for December, it means we want the insurance for 1 December to 28 February, not from 1 December to May. No. So we'll calculate. Okay, if they paid 3,000 for 6 months, how much were they paying per month? So we'll say 3,000 divided by 6 is equals to, so 3,000 divided by 6 is equals to 500. So it means per month they were paying 500. Okay, now let's say 500 is for December, another 500 is for January, another 500 is for February. So we're not going to talk about March, April and May because it's another financial year. Remember, we must close here at the 28th of February. So it means our insurance for these 3 months which was outstanding is 1,000, which was paid in advance. So for December, January and February is 1,500. So we'll come and say how much was the insurance for the year? It was 5,490. So on insurance we'll say insurance